Lilladher also joins in on the show. Amisha, just want to, get in your sense as to how much of a market-moving event you think the WPI inflation numbers will be. Good, bad or ugly, we've completely been ignoring it because it's clearly the big event on the 16th that's going to drive momentum.
So currently you are absolutely right that all market participants, be it domestic, be it FIIs, are riding the wave of regime change and maybe very decisive kind of a mandate which can turn around the things in medium term. That's the hope on which markets are moving. But the moment we pass through that particular event, I think the market sides will definitely be back on the core fundamentals and the action plan to tackle inflation, because that's the first macro after CAD which needs to, and fiscal deficit, which needs to come under control.
I'm going to have to cut you short there. I'm afraid I'm going to have to cut you short there, Amisha. Apologies for that. 5.2%. So you do have the April WPI inflation, which has come in even lower than what we were expecting. Remember, in terms of the consensus range, 5.3 to 6.2. I'm going to take it straight across to Radhika. And Radhika, if I'm not mistaken, you were also working with a 5.7%. So how would you react to a 5.2 for the month of April?
Even with the 5.2%, I think there has been a month-on-month increase, but of course it is not as sharp as we expected. We'll wait to see the breakdown, but I would think the easing off could be more to do with the fuel index and probably some moderation in the manufacturing as well, while food prices held up their last month's gain. But I think that's what we need to watch out for, and we need to see the numbers to see where the core is, which will influence largely where the central bank's prerogative is going to be. But the RBI has made it clear that it's going to look past transitory as well as one-off factors and concentrate on where the trend is overall. If inflation continues to be on the glided disinflationary path, then RBI will react accordingly. But for the time being, I think they're still going to maintain rates unchanged into this fiscal year.
Okay. We'll come to the RBI possible action as well in a bit, but just to lay out the figures, 7.06 primary particles inflation, fuel and power has seen a drop, 8.93 versus 11.2, and food inflation, Sajid, that's something that you were referring to, is at 8.64% versus 9.9%. So month on month, there is quite a bit of a drop, almost 130 or 140 odd bips. Short-lived, do you think?
Yeah, month to month this will bounce around a lot. There's also base effects in play, but prima facie this is a positive surprise. I think at 5.2 you actually have a negative month on month seasonally adjusted movement, and from what you mentioned, both the fuel items as well as food is below, has shown a negative a momentum. I suspect one of the things that's going on is you've also seen in the month of April some appreciation pressures of the currency. And remember, the WPI, unlike the CPI, has a far greater proportion of tradable goods, which are at some level tied down by the law of one price internationally. So I think those appreciation pressures may have filtered through, have provided some disinflationary impetus. But from the two numbers you mentioned, both food and fuel, the month-on-month numbers negative, which in the case of food is a bit surprising because you saw a pretty sharp increase in the CPI. So retail food prices have increased month on month from March to April, but wholesale food prices seem to have declined, which is slightly surprising.
Incidentally, the WPI inflation is the lowest since Feb 2014, and the food inflation also, I think that's your big surprise there. It's at the lowest since February 2014 as well. Just some more data. You have the Feb WPI inflation revised to 5.03% versus 4.68%. And of course, we flagged off the fuel and power inflation much lower than what we were expecting at 10.7% to come in at 8.93%. Gaurav Kapoor, senior economist at RBS, also joins in on the show. Gaurav, your reaction to 5.2%, are you pleased?
Somewhat of a positive surprise, definitely. And especially, but that said, I think the caveat would be that food prices with somewhat of a deficient monsoon expected, I think it's perhaps a little too early to even see this as a prolonged positive. Yes, this number per se is positive because it apparently seems from the details you just shared that food inflation has come down. So I think we'll have to dig down deeper to see where exactly has this, where's in what categories has there been a disinflationary tendency between compared to the previous months. But I am still somewhat skeptic about the fact that you will see this continuing, because as Sajida also pointed out, CPI inflation, if you see in the month between March and April, food did show up a pickup, and I think that's what you tend to also see between April and June generally. So I think I wouldn't be surprised that this number may actually get revised upwards quite sharply going ahead, and you would perhaps see the impact of food prices or the expectation of a deficit monsoon building up as you get into the numbers in May and June. So as of now, yes, I think it's the surprise on the positive side, but I think perhaps the devil lies in the details, and I would still think that the final number may actually be somewhat higher and closer to 570, 580 is what the initial or the consensus estimate is.
Okay, so yes, it is a positive surprise. No taking away that fact. It's a consensus from all our guests. We have a battery of guests. We'll just try and go to one each. Let's go to Anant. He's joins in as well. Amisha is with us too. But Anant, to you first. And one, your reaction, yes. And two, I mean, is this something that could well reverse in the months to come? Because all our guests have said that the problem of food inflation in particular is sticky, and this surprise may probably be short-lived as well.
Yeah, look, this is a positive surprise. Like, I guess all of us agree on that. And
yes,
frankly, we were expecting a print closer to 5.8, 5.9. So fantastic to see this print. But frankly, I don't see this as being market moving for multiple set of reasons. One is, of course, WPI is diminishing in terms of value for the market, given the RBI's concentration on the CPI. The second is, we all know that the big numbers to worry about on inflation would be once the monsoon starts to step in, and what the impact of the El Nino is and how the monsoon crops look like, etc., etc. So we're more worried about how inflation pans out over the next 3-4 months rather than the current prints right now. The third is, of course, we are all right now obsessed with the election results and what that means for immediate policy, both on the economy front and therefore on the monetary front. So there is less kind of importance being given to these kind of prints. And lastly, I think in the financial markets per se, the more watched market right now is probably the FX market, which should react the most, depending on what the results pan out tomorrow over the next medium term. So I guess there's a lot of concentration on that. So all in all, great print, good to have, but will be kept in the back of the mind, and I think the market will move on.
Great print, but no reaction when it comes to the bond markets or the currency markets, really. 8.83% when it comes to the 10-year bond yield right now. And you also have the rupee, which is pretty much unchanged, 59.47 to the US dollar, 4.8. That's where we're currently at. And the frontline index seems to be really ignoring this data completely at 7,090 on the Nifty as we speak. The Sensex 2 is continuing its sideways move. Amisha, apologies for cutting you short there, but wanted to get in your reaction, particularly on the food inflation number as well as the headline number at 5.2.
I think both the numbers have given, at least for this month, a very positive surprise. There's no doubt about it. And, one of the important thing to consider even for next couple of months, while monsoon will be definitely watched at, but if the positive outcome of this election poll continues, then one is expecting rupee to appreciate or strengthen a bit more, and that will also have its positive impact on inflation numbers as we keep going forward, and will keep creating comfort in terms of inflationary pressure from imported items settling down. So I think keeping these two in mind, this number should be viewed positively. Only caveat is right now market is too obsessed with the event tomorrow, and that's how this number will be slightly ignored for the time being, and markets will take its due cognizance only after tomorrow's results are out.
Yeah, which is a fair point. And Sajid, coming on that, I heard a number of voices over the course of the last 1 week say that RBI intervention in the currency markets has been welcome, and they will probably continue to intervene if the rupee appreciates. My question is, for a net importing country like India, and we are working with the hypothesis that there is a stable government announced tomorrow, and if indeed the currency does appreciate, why should the RBI intervene in the first place? And what's your base case scenario for the rupee?
Yeah. So a couple of reasons why a central bank should intervene. I think it all depends on, firstly, where is your currency relative to fair value? Now, fair value is a very complex concept. It's a dynamic concept, but ultimately it goes down to productivity growth differentials between India and its trading partners and inflation growth differentials. Most people would believe fair value is somewhere in the 60 to 62 range. So if that's where your nominal fair value is and your inflation differential in any case is high, you know, CPI core is running at 8%, the world's core CPI is closer to 1 or 2%, you will have a 6% real appreciation of your currency, even if the nominal exchange rate remains exactly where it is over the next year. Now, if you allow that to appreciate 4, 5, 6%, you will then end up with a 10, 11, 12% real overvaluation, so to speak, which could be very harmful to the export sector or the import competing sector, your tradable sector, which frankly are the only impulses of growth right now. So I think the first reason is you don't want too much overvaluation. The second is, I think the lesson from 2013 was quite clear. Two things matter for emerging markets. One is policy credibility. The second is a large buffer stock of FX reserves. Let's not forget our short-term debt obligations with a residual maturity of 1 year are very, very high. What the RBI will need is a massive buffer stock of FX reserves to protect India from Fed normalization over the next 2-3 years, so we don't have to undergo what we went in the summer of 2013. For that reason, it makes perfect sense to now use this opportunity of flows coming in for political reasons, so to speak, to build up your reserves. So I think I'll conclude by saying it depends very much whether the currency is being driven by economic fundamentals or by by sentiment. If it's economic fundamentals, inflation comes down, productivity growth goes up, by all means, rupee appreciation should be welcomed and will be sustainable. But if it's happening because of an event risk, you really don't want to interfere with those fundamentals and in fact use that opportunity to build up your reserves.
Radhika, on the whole, how much weightage do you think one should really give to the WPI numbers, given that the RBI has been focused on CPI so far?
Yeah, WPI has become a number that has to be watched in the rear view. Just like the other guests shared, WPI has, so basically you just watch the trend, don't react much to it, but CPI and the core CPI have become more important as policy determinants. And looking at the numbers that were released late last week, both are at worrying levels. So still CPI, I mean, the glide path for the central bank is at 8% by Jan 2015 and 6% 2016. So it's clear that the governor does not see this inflation panning out as a linear trajectory. He thinks that there are going to be bouts of ups and downs. But as far as we don't deviate too much from about, say, 7.5 to 8.5, then we are at a good place. But if it blows out and it shows signs that from food pressures we are moving on to generalized food price pressures, showing in core, showing in inflationary expectations, then there is need to react. Otherwise, CPI in the about 7.5 to 8.5 range, I think would be considered not too much of a differential in terms of at least a CPI trajectory.
Fair point. Gaurav, I want your view. I know Anand's view on this. We just spoke to him a few days back and he mentioned that the RBI in all probability would continue to intervene because the level of reserves that we have is far lower than the external debt that we have. One, do you think that will happen? Two, do you think if there is a stable government tomorrow, the RBI may well lower the levels that it has in mind to intervene because the gush of liquidity could be large and swift?
Well, I think I do actually see this is actually the right time to keep building up reserves. It is definitely, but given the kind of flows, given the strength of flows, it would depend on what the comfort level, RBI's comfort level in terms of intervention may shift a bit. I mean, adding to the point Sajid was earlier making about the valuation, the fair value, if the newly issued CPI based real effective exchange rate index shows that on a 6-country trade weighted basis, rupee was in April overvalued by over 11%. In case of a larger basket of 36 countries, it was overvalued by about 4%. So that would be at the back of the mind of the RBI. But any which ways, I think building reserves at this point in time is a very good idea. In fact, all emerging markets since January, emerging markets which have been under pressure in 2013 are doing that. And if we do see a flux, do see a large inflow of say FII money in the next 2 to 3 months, say in the vicinity of about 20 to 30 billion dollars. And let's not forget, between 2.5 months from September in the swap scheme, we did manage to get to 34 billion dollars when there was a lot of negative sentiment about India. And now if with the stable government and you have a positive sentiment, the flows can actually be fairly large in the next couple of months. So I think while RBI would continue to build reserves, they might actually allow the band to move a little bit towards, say, between 58 to 60, then 60 to 62, or perhaps 56 to 58, because see, sterilization will have its own challenges, but that's something which they would be worried about as well. So I think overall, and considering the fact that you're looking at very low degree of comfort with inflation, even with even with somewhat positive trends thrown up by the WPI data in this particular number, in general there is a sense of discomfort on inflation. So keeping that in mind, I think RBI would be somewhat skeptic about letting the rupee appreciate too sharply. They would continue to build reserves. They might allow the band to move a little bit on towards closer to 58 than it is now. Apparently 58.5 is a crucial level which the markets are looking at. So I think it's a good strategy to build reserves at this point in time to create buffers for any major global event. I mean, you have the policy normalization by the Fed. So as of now, markets have kind of priced in a $10 billion kind of unwinding of QE. The next step would be when the Fed actually starts raising rates. Now, if those expectations are, as of now seems to be somewhere in mid 2015, but if those expectations change, there could be a change in the environment, in the way investors are looking at emerging markets in general. So I think this is the time when you have the opportunity of building reserves, RBI should do it. And I think gradual appreciation of the rupee, if there is a huge inflow coming in, is perhaps a good strategy at this point in time.
Anant, wanted to get in your view as to what exactly you're expecting from the Reserve Bank in the policy meet scheduled on the 3rd of June. Do you think as the progress of El Nino comes about, as the fiscal policy of the new government is more clear, they are likely to leave the repo rate unchanged?
Yeah, I think they will watch how inflation pans out. They will watch also, I think, how the currency pans out. You know, it's interesting to have these discussions on the rupee from the RBI perspective, and I completely agree with Gaurav and Sajid that the RBI should continue to intervene at this stage. But it's also important to look at how the rest of the market will look at the RBI and at the currency. Now, one trend which I foresee happening for the right or wrong reasons is exporters will probably look to increase their hedge ratios. Investors will probably look to come in as well into the country. You must remember that the rupee since September last year has been the best performing currency globally in terms of total return. It's given a return of close to 18% since then. And with a favorable result, and of course it's all predicated on a favorable result tomorrow, the chances that we have a blowout or a jump diffusion kind of event on the rupee goes down even further. So even with the rupee remaining where it is, with the RBI buying and mopping up dollars, given the interest rate differentials, India would be an attractive location to bring in dollars and just earn the carry. The third thing is importers and folks who have been covering on their dollar liabilities would sort of desist from doing so right now. One, the expectation is of a stable, if not an appreciating rupee, and B, the cost of hedging by buying outright forward dollars is simply too high given the interest rate differentials. So all of this will mean that the system could take on the RBI and their intent to mop up dollars over the next few weeks and months. And that could become at some stage a factor for the RBI to keep in mind in designing their monetary policy. Some of this might sound like jumping the gun, because let's not forget that just a few months ago we were scared about the fact that there are not enough inflows coming, there are too many outflows, and are the level of reserves enough for the RBI to stave off any kind of large outflow from the market. So it does seem kind of early to think about the reverse case, but as the flows come in and as the market starts to take on the RBI for a variety of reasons, that might become a factor in the monetary policy. The last thing on the monetary policy, I think, is while the RBI won't say it, and I know Sajid won't agree with me, but I think one of the reasons why the country needed high rates in the second half of the last year was simply because the volatility on the FX side needed to be controlled. Now, if the rupee is starting to behave itself and the sentiment about the rupee starts to change going forward, I think a huge reason, along with inflation, for rates to be high sort of goes away from the table. So the need for rate hikes, I think, goes down to that extent. So to the extent that even if you have a high inflation print because, let's say, of a weak monsoon and a bad agricultural output, that need not immediately translate into a requirement for higher rates right away. So I think the market will start building in, with a stable rupee, the probability that RBI would at least stay on hold, even if they don't cut, even if inflation prints surprise on the higher side.
Sajid, understand we have to let you go, but before that, your quick comment as well on what do you expect the Reserve Bank to do?
I think in the June review, I think as per their guidance, and I think they will stay on hold. I think the next big milestone for the Reserve Bank will be in July. There'll be two big triggers there. One is the progress of the monsoon and whether we have this El Nino effect. The second, of course, will be policy, will be the budget, and I think that's going to have a crucial bearing on the outlook of the economy in the coming months, and therefore what the adjustment from the central bank should be. But I think in terms of a larger time horizon, I agree with all the points Anant made. I just think now there is a very public commitment to numerical targets. There's an 8% commitment for next January. There's a 6% commitment for the following January. And so I think when you make these public commitments and credibility becomes so important, I think the central bank has to be data driven. That if in fact growth does not pick up, there's downside pressure on inflation, and we look like we are gliding towards 8%, I think there'll be every reason to stay on hold. Similarly, if you have a temporary shock in food prices, which will mean revert or normalize in a few months and not transmit into a more generalized inflation, there'll be good reason to be on hold. I guess the only point is if, however, a few months from now, and base effects apart, the momentum of inflation is running well above 8%, either because growth has picked up sharply and therefore the pressure on core inflation rises, or because you do have a pretty significant food shock which is transmitting into wage pressures and therefore more generalized inflation pressures, I think it'll be hard for the central bank to look in the other direction, given that they now have a public commitment. And I think hitting those first two targets becomes very crucial to establishing credibility. Everyone in this panel has spoken about inflation expectations. I think most people agree inflation expectations in developing countries are adaptive, they're not rational. So when you talk about affecting and influencing and containing expectations, you need to bring inflation down. I think therefore those first targets become important. How monetary policy reacts in the coming months, there are just too many moving pieces. What does the fiscal deficit look like? What will the budget be? What happens to commodity prices? How the monsoon progresses? I think it's safe to say that the RBI stays on hold in June, but will do whatever it takes to make sure that we don't deviate from those targets by large amounts.
No, I completely agree, Sajid. There are too many moving pieces. We're essentially trying to focus on June 3rd for now. But thanks, Anant. Thanks, Sajid, for taking the time out and being with us and giving us your views on these numbers. Much appreciate you being with us. Amisha, I'm requesting you to stay on for 5 more minutes because there is a larger event, as you said, at hand, which is tomorrow. And while we've spoken about it, I think a few days back, I just wanted to ask you, a lot of market participants seem to be believing that in the near term, that is the next 10-15 days, irrespective of whatever outcome is, there could be some bit of a correction after a bit of an initial blip should there be an NDA government. Do you think that is possible? Because there has been a bit of a run-up that we've seen.
See, I think that if they really manage to bring the numbers 270, 272 plus kind of a number as predicted by exit poll, no, I don't think a very major correction at all. I rather feel that there is a possibility market will scale instead of any circuits or anything 3 to 4% up. But I also feel that that event will take the bottom of the market of any correction much further. Sometime back we were thinking 6,000 was a good bottom. Then we thought 6,400, 500 is a good bottom. But if this 270 plus kind of a number comes, I would believe that 6,700, 800 will be a good bottom. In that case, 7,100, 150 is not a very far away cry not to invest or post-event and conformity of the event. Other important thing is some of the other fragile five or emerging markets within that segment have done probably much better than India. So it's not that this round of 12 to 15% rise is something which is only occurred in India when it has achieved stability in currency front. So I don't see if the results have met with the expectation, still there will be a big correction. I don't think I agree to that.
Amisha, you know, the general consensus on the street now seems to be to chase cyclical stocks, to chase industrials. Would that provide comfort, given that now we're already looking at those 7,100 levels?
I would think so. The weightage overall in terms of within the portfolio of IT and pharma for next quarter or so will continue to remain stable, or it will come down a bit, rather it will be slight underweight. But the cyclicals, gradually people will have to keep adding, be it cyclicals in terms of financials, be it in terms of cement or metals, because within metal space you will find that yes, broadly the China slowing down has its impact on global commodity prices, but most of the large players here are impacted by some or other policy driven or decision at the center level kind of an issues, be it Sterlite, be it Jindal Steel and Power, to some extent be it some of the other large metal and commodity players. So they will have a different kind of a trigger, but I think both these segments will continue to do well as they are positioned for a slightly better growth. So I think that yes, the important